Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my June 7th energy update. But first I want to emphasize an important empirical fact contained in my May 3rd energy update. I said prices were consolidating above long-term support near $2.50 per million BTU, and in the process of forming a pattern similar to what took place in 2001, 2012, and 2016, when early in their bull markets they formed patterns of higher highs and lows, and the average price was always higher at least 3 years. This empirical fact is the foundation for today's video. Based on this empirical fact, as you can see in this next chart, I was not surprised natural gas pricing consolidated above long-term support near $2.50 before moving higher, and is now consolidating above its spring shoulder low. A consolidation pattern is simply a pause in a trend in which a market trades sideways for several weeks prior to moving out of the pattern. In 45 years of trading commodities, it has taught me there are no hard and fast rules guaranteeing the future direction of commodity pricing. But some patterns do increase the probability a market will move in a particular direction. When consolidation patterns form early in long-term trends, more often than not, they are continuation patterns, and the trend continues in the direction that it came from. Therefore, since natural gas is consolidating above long-term support near $2.50 and is now forming a pattern similar to what took place in 2001, 2012, and 2016 when pricing was higher for at least 3 years, natural gas will likely move higher from the present price levels. Also, in my May 3rd energy update, I said our government's fiscal policies will likely lead to inflation. In response to the corona pandemic, our government has increased deficit spending at an unprecedented rate, and the Fed aggressively has implemented quantitative easing, which is flooding the monetary system with cash. Clearly, these policies will increase the risk of inflation, and the bond market is signaling inflation is on the horizon. Long-term bonds decline when inflation rises because future payments from bonds won't buy as much. When traders believe the cost of goods and services will be higher than it is today, bonds are less desirable and their prices fall. And as you can see in this chart, this is what has happened to long-term bonds over the last year. But over the last 3 months, bonds have been consolidating. The question is this a continuation pattern forming prior to long-term bonds continuing to move lower? I believe it is, based on what U.S. Treasury Secretary Janet Yellen said Sunday. She said higher interest rates would be a plus for policymakers, and she said we've been fighting inflation that's too low and interest rates that are too low now, and we've been doing this for a decade. Over the years, I have learned that when the Treasury Secretary says inflation is too low, rest assured inflation is on the horizon. And as I said in my May 3rd energy update, with inflation on the horizon, I believe 3 years from now you may look back and realize there was only one cost of doing business you could have stopped increasing: your cost of energy for natural gas and electricity. Therefore, I believe it is in your best interest to secure fixed natural gas and electricity rates at this time. Hopefully this video helps you appreciate why this is so, and until my next report, please take care.